Now, banks are both the epitome of capitalism, and in many ways, and far too often, or at least regarded as such, it's worst advertisement. And it's not unusual for banks and bankers to be heavily criticised by the societies in which they exist and operate. On the whole, in Britain, I would say that these issues have been handled very well historically, and that's part of the reason why the city has been an important part of the economy. However, around about more than 15 years ago now, there was the crisis in the banking system, and then there was a regulatory clampdown on the banks. And what I want to show is the effects of that clampdown. I am biased in all this. I used to work in the city. I believe in capitalism. You know that. You can apply the appropriate discount to what I say. In my view, there was effectively an attack on the banks. And this affected the way that the banks could help their customers, including companies, including particularly small companies, and I'm going to show you the evidence for that now. In the early post-war decades in Britain, banks were heavily restricted in what they could do. In the Second World War, banks had lent heavily to the government. If they started to lend more to the private sector, this caused a boom in the economy, balance of payments deteriorated, and so that was stopped. Interest rates went up, or there was just simply a clampdown on lending to the private sector. No more lending to the private sector, finish. There was then an easing up of that in the early 70s and then again in the 80s. And you can see those two little mountains there when the growth of lending rose relative to GDP. This is all lending direct to GDP, lending to companies, and that's all companies, including big companies. Then there's another mountain up in the Blair period, peaking in 2008 and 2009, and that is when the banks themselves started to become reluctant to lend to each other. This was in the summer of 2007. The problems weren't sorted out properly, and then in autumn 2008, we had a further set of problems where such banks in Britain as Royal Bank of Scotland and HBOS had to borrow from the Bank of England, and did it very discreetly, by the way, but there was then a drastic change in regulation. And this had several aspects to it, but perhaps the key item was that banks had to have much more capital, about 60 or 70% more capital relative to their risk assets than before. And so you're a banker, you're told suddenly you must have much more capital relative to your risks. What do? You cut back on the risks in your balance sheet. And what this chart shows you is that lending to companies, which was risky, fell heavily relative to national output in the next 5 years. This was really, the rules was kind of consolidated in late 2010, but the banks knew about them from late 2008. So what had been booming, in fact it's been growing strongly for some decades, fell quite heavily. And you can see this little pickup in 2020, that's bounce back loans and things like that. That's not a serious change. And this decline sort of continues, but not at the same rate. Big companies can offset this by going to capital markets, and they have done so to some extent. But if we think about, this is a series of data prepared by the Bank of England, which I'm a financial analyst, among other things, I have to dig up the numbers and so on. This shows you lending to so-called unincorporated companies, unincorporated businesses. This is very small business, family businesses, businesses where there's just possibly just one man and one woman just running it from the garage or from a market stall. And in 2008, it's all never been very big, but it's a kind of symptom of what's been happening in Britain since that period. It's collapsed. It was about 2.5% of GDP, and it's now under 0.5% of GDP, and it's still falling. So there was this attack on the banks, and the result was less lending to companies, a sharp drop in lending to small companies. Was this relevant to Britain's growth performance? Was it relevant to the productivity slowdown we've been talking about today? Yes, it was. I'm not claiming it was very important. It was an aspect of what was going on. It had some bearing on probably fewer people set up businesses than they'd otherwise have done. It wasn't like in the Thatcher years and even in the Blair years. So my final picture is this, which is lending by on overdraft. You see, you're running a small business. You want to buy something you're going to sell. You want to have a stock of, I don't know, clothes or books and sales. I think just say, a bookshop or something. So you get that, you go to the bank, I have a loan to go and buy something and sell some customers. And I want an overdraft. And the bank, in the old days, would have said, fine, have a look. You can see the top line is lending, these are nominal amounts, lending to large companies. The red line is lending to small companies, going down relentlessly into today. What were the changes in 2008, 2009, were the only thing responsible for all this? I'm glad to have Brandon here to give us a bit more of an answer. They were. Obviously, this raises larger questions about what's motivating these people. We can talk about that later. I think now I just summarize by saying my words that so these assets, these bits of what banks' businesses, they've gone down relative to their balance sheets, right, not asset totals. I hope they use words like assets and liabilities in the current company. The other bits of the assets have gone up, of course. These have been government securities and cash reserves. What good do they do us? I'll pass over to you now, Brad.
These days I'm a professor here teaching master's courses and PhD, but my whole career was really in the city. I've been the treasurer of Barclays Bank. I was head of structured products of Barclays Capital, the first one. I then moved on to be director of a number of, non-exec director of a number of banks. I then turned my hand to tech companies, and today, in fact, I'm actually a part owner of an AI company, director of it. But what has always fascinated me is how does growth happen? And I got onto this because I started to look at bank balance sheets. And I looked at the bank balance sheets from the days when I was treasurer 15 years ago, and I look at them 2008 or so, and I look at them today, and they're completely different. A UK bank balance sheet today looks nothing like the bank balance sheet looked at in 2008. Not a little bit. In 2008, and this is the one that really, I think, stands out in the whole thing, sterling lending by the banking system to corporates, unincorporated businesses, was then 500 billion. Today it's 450. That's a fall of 46% in real terms. If the same figure applied and the same growth rates applied to the pre-2008, today it'd be over 800 billion. What are those loans to companies? They're capital. If you start a small company in the UK, and there are 5.5 million of them, if you start a small, and we create about 600,000 a year, we lose about 600,000 a year. I'm not saying one's one hopes. Yeah, that's capital. That's where you get your capital from. That's a loss of, 46% of the capital going to these companies in aggregate. What does capital turn into? It turns into capital formation. It turns into the things that you buy in order to progress your business. Be it a transport business, be it a computer business, doesn't matter, it's the capital. Software, hardware, whatever. It's how you build a business. Now you haven't got the money to build it. So what happens to productivity? And the paper I prepared this goes all the way through the correlations and growth rates and all this stuff. But basically what it shows you is they all decline together. The capital available declines, the capital formation declines, the productivity declines. So if you want a significant portion of the UK's problem. It is that these 5.5 million companies are starved of capital by a banking system which is designed now to finance governments, not to finance private sector. This is holding of gilt-edged securities. That's cash reserves. Cash reserves, incidentally, today, when I was treasurer, it was basically nothing. It was enough for the clearing in the evening. You targeted something fairly close to zero. You didn't never got there, you got to within tens of millions, but it was very small. Today, it's bigger than the lending to the whole of the corporate sector. That's cash sitting in the bank. Why? That bears no capital requirement, it bears no liquidity requirement, it doesn't come under the gearing ratio, it is basically a free asset on which you will receive base rate. It's an astoundingly good deal. Why did banks skew themselves this way? Because of the regulation, and solely because of the regulation. Banks in 2008, their market to book, pretty happy with market to book, market value of the bank versus the book value of the bank was 0.5. 50 cents on the dollar, 50 pence on the pound. That's all it was worth. You had to manage the capital very strictly. You had to manage to make a return on that capital to get your shareholders back to believing in you and to revaluing your shares. It only happened about 18 months ago that it broke through the pound. Yeah, from 2008. This happened about 18 months ago that we went back to just over the pound. So what you end up with is a banking system that is designed around holding gilts that can fund the government, holding reserves, and not lending to the corporate sector. And incidentally, if you want to get into it, they've also turned themselves largely into building societies because the Basel regulation also greatly favours the pledging of capital. So basically, pledging of assets. So it basically says you're in a sort of pawnbroker. You shouldn't be interested in the proposition. You should be interested in the assets that are being pledged, because that's where your capital is going to be rated to. So when you look at, and I've got another slide on this, when you look at secured lending versus unsecured lending flat as a pancake dead. Secured lending going up all the time. Banks turning themselves into building societies. None of this much happened in America. And America is about the only one where it didn't happen. And why is that? Because American banks don't look like any other bank in the world. American banks originate and distribute. It's a securities business. They're part of it. I used to work in Salomon Brothers. It's a securities business. In the rest of the world, it's originate and hold. You originate the assets and you hold them on your balance sheet. If you look at the ratio of bank balance sheet, if you look at the ratio, of the total amount of assets in the banking system in America, it's about 100% of American GDP. If you look at it in Europe, it's about 350. The difference is capital markets. American capital markets are a whole different ballgame to capital markets anywhere else. And if we were to try and create a European equivalent, we would need to originate additional capital markets of about 80 trillion euros. It's an enormous job. And it isn't going to happen overnight. Just if at all. Just one more. Okay. I think I've said enough.
Great.
I hope what you got from me is that SMEs are important, and I don't think there's any secret as to why our productivity in that sector is not what it was, and it is because it's starved of capital, and that's because of the banking reforms we brought in, which have made the banks extremely secure, incidentally. But if you take the loss of GDP, and I kind of halved it, and you have to go into the paper to see how I've done all that. But basically, what I was saying in the paper is that we have already generated a loss sufficient to pay for 2 super 2008 crises, which eliminate the entire capital of the banking system in the UK each time. And we've already lost enough GDP to pay for 2 of those, and we lose it at the rate of about 1 a year, 1 every 10 years.
Brandon, thanks. Lovely. Very good. Thank you. I'm just very quickly going, for Britain, its international financial services sector has always been very important, simply because it generates a lot of exports and a lot of value added. It's a very crucial part of the economy, certainly of the south of England, perhaps less so of the north in Scotland, but still quite important there. This is a chart of the value of Britain's financial services exports from the late 1990s until a couple of years ago. And it looks very healthy. It's going up all the time, isn't it? Well, it was going up fairly sharply until 2008, and then you can see it levels off, and then it kind of resumes. Banking is not the only one of the activities here. There's also bond market origination and trading, there's derivatives origination and trading, there's insurance, there's an unbelievable amount of activity going on. Normally what's happening is there's some clever people, they're clever and well-paid people, they've got a lump of capital, they're taking some risks, they're trying to make money out of taking risks that reduce risks, by the way, for the corporate customers who are all around the world. That's basically what's going on in all these activities. The very high value added, very high use of computers. Anyway, and then we had 2008, 2009, the Basel rules. Various things were interfered with, such things as credit default swaps, where I think not everybody in the room has the same views as me, but anyway, such things were told they couldn't stay in London anymore, they had to go elsewhere, and they did go elsewhere, and so it goes sideways. This is a very important activity to Britain. It shows you the growth rate of the financial services exports. They were exports. There were some services to, I have a stockbroker, so I'm in Britain, but most of the activity was in fact exports. They were growing at 11.5% a year in that decade up to 2008, about 4.5% since then. 4.5% is in line with the rest of the economy. I put it to you, an important growth industry was stopped in its tracks. Now look, I'm exaggerating, there's much more to say here. All the same, that is a reasonable hypothesis. Trying to understand why our growth rate fell, it's part of the story. Thank you.
We're going to continue with Jill Cetina, our colleague here. She's the Associate Director of the Commercial Banking Program and an Executive Professor of Finance at Mays Business School at Texas University. Before that, she was Managing Director for US Banks and Moody's, and very important for the discussion of the topics we're going to have later today. She was the Vice President at the Federal Reserve Bank of Dallas. So please, Jill.
Okay, well, thanks so much, and howdy from Texas. So I'm going to agree on a few points with my co-panelists and also disagree, not to be disagreeable. But I'm going to start off with maybe what I agree with. So I think there were some points raised about excessive government debt growing on bank balance sheets. We actually have this in the United States as well. This was, of course, one of the problems for Silicon Valley Bank, which failed while I was at Moody's and got to deal with that. But I would, as a former central banker, on the topic about growth in banking system reserves, point out that the amount of balances that the banking system holds at the central bank is purely a function of monetary policy. It is purely a function of how much reserves the central bank, through unconventional monetary policy, decides to inject into the banking system through what is commonly known as quantitative easing on the way in and quantitative tightening on the way out. So when we see very high balances, banks have no ability at the level of the banking sector to get rid of those balances. So just to kind of take a step back, I think the big thing to think about here is that fiscal policy which was the topic of our first panel, which has been allowed to, in many advanced economies, both here in the UK and in the United States, I'll say run amok a bit in terms of ever larger budget deficits and debt to GDP, that is crowding out the private sector. And I think we agree on that point. Where I think I have a bit of a different view is I'll say, role of reducing capital standards in this whole discussion. So how did we get to incredibly elevated government debt levels? Part of the way we got there was, at least in the case of the United States, we had a banking crisis that resulted in a very significant add to government debt to GDP because it became privatize the gain and socialize the loss. And so I think it is important. I worked at the Federal Reserve for 2008. There was a lot of that that happened. Anyone know offhand how many people were criminally prosecuted in the United States for fraud around our mortgage market? One person of relatively minor importance, okay? So I think it is fair to say that we need some guardrails, if you will, around excessive leverage in the private sector so that this doesn't end up on public sector balance sheets, because that's what happened in a very significant way in 2008, okay? So if we don't want that to happen again, after 2008, we created a very rules-based framework, which is the Basel Standard. We kind of expanded on that to a very significant degree, so I agree with my co-panelists about that. The alternative would be to say, okay, we're not going to have as stringent of a standard like that, but we instead are going to have something that, there's more skin in the game on the part of financial institutions. If you engage in fraud, you will be criminally prosecuted. If you are not honest in your financial statements, and as someone during my time at Moody's, I dealt with a bank in the United States that had financial statements that were not, I'll say, up to snuff, to use a UK phrase. So these things are real. They exist, and we need to, I think, establish, if we want to move away from a prescriptive rules-based framework, we need to create incentives in terms of clawback of compensation, executive compensation. We need to have bail-inable debt. We need to have other things that will prevent the onboarding of risk to the public sector balance sheet, okay? So I do think that particularly at this moment in time, as we're sitting here in the midst of an unfolding energy shock that's going to affect very acutely the UK economy, when I think about there being less capital in a banking sector at a time of macroeconomic shock, particularly at a time of stagflation, that is a worry from my vantage point, right? It's one thing to talk about easing capital standards in good times, but as my mentor, who both owned a bank and ran a hedge fund, liked to teach me when I was about 25, banks are levered plays on the real economy. And what that means in a nutshell is that if you're going into a macroeconomic downturn, you need more capital, not less. And so I think that there's certainly things to talk about where we could improve banking regulation, but I think this conversation around meaningfully reducing bank capital is a little bit, at this moment, ill-timed, okay? So thinking about skin in the game, thinking about bail-inable debt, thinking about, again, other things that are not capital-oriented, I'm all for it. But I want to come all the way back to the beginning of today with the first panel. Fiscal dominance is the top issue in my view. It affects monetary policy. It's affecting the functioning of the banking sector. And if we start with reducing in an immaculate, I'll call it, way, and what do I mean by that? We don't want to overly tighten fiscal policy. That can cause, as we all know, a recession. But to start to move towards a 3% budget deficit to GDP, that can get us positioned so that interest rates can come down, the central bank can ease, and we can evaluate in a responsible way how to reform financial regulation. So I'll leave that as my remarks and turn it back to you, Juan. Hopefully I didn't
It was perfect.
go my time. Thank you.
Thank you. Yeah, thank you. Very nice. So before we start the discussion, I just want to suggest other topics. It's not that topics you have suggested are not interesting. They are very much so. But I wanted to throw to a table central bank independence and accountability. We cannot discuss central bank independence without accountability, in my opinion. If anything we've learned over the last two crises, that central bank independence never survives a crisis episode. The pressure of the government to monetize the deficit is far too great. And then we can discuss different monetary policy rules to tie the hands of the regulator, be it the government or the Bank of England in our country. Financial regulation, that's something you have discussed already. And indeed, in relation to tying the hands of the Bank of England or the government with a much more binding monetary policy rule, I would very much put on the table the need to establish a credible fiscal rule. A rule that minimizes the risk of fiscal dominance. I very much agree with you on that. So, who wants to start, please?
Can I start?
Please. Yeah.
Okay. First of all, I'd like to put something on the table. I'm not in favour of less capital for banks, but I was very much in favour of Silicon Valley Bank having an awful lot of capital against the huge interest rate risk it was running on its government bond portfolio. We allow banks to run massive risks on their government bond portfolios and charge zero capital against it. That is crazy.
Yep.
Why couldn't the manager?
Sorry, could you pass over the mic?
I grant unless you look, management's there to manage. I mean, God sake, you're running a big bank. I don't know, never ran a big bank. Look, I was involved in a broking firm. We occasionally had a huge balance sheet relative to our capital with most all gilts. Every now and again, a customer didn't pay. I mean, and then we got the risk of we got unlimited liability. For God's sake, we don't need regulators to tell us what to do. For God's sake, why can't we do these things ourselves?
Well, under Basel II we did, first of all. Under Basel II we did. Basel III was the problem, right? Because Basel III basically re-established a set of set ratios. We end up in a position where we've got 50 cents on the dollar in value in our capital. We've got to get that up to 100. The only way of doing that is to manage the bank on the regulatory capital because it now exceeds what we think is the risk capital the bank would run. If you look at Barclays' earlier results, you'll see that it did for a time actually publish its risk-based capital versus its regulatory capital. Its risk-based capital, it always thought was in excess of its regulatory capital. After 2008, that changes completely. Well, and therefore, the way you manage the bank has to change completely, or you're going to be taken over, or whatever. Because you can't give 50 cents on the dollar to your shareholders, or value their business at 50 cents on the dollar.
Because I knew I was going to tell this, but I didn't have my third coffee today. But Jill, do you have something to say about Tim's remarks?
Yeah, maybe just a quick couple thoughts. I do think that we have created, unfortunately, in the banking system, a culture of compliance as opposed to a culture of risk management through having very prescriptive rules. The question is, I think, though, once you've created that system, how do you reform out of it? Because it's not just reforming the system. You have created people who believe that risk management is that. So like in the case of SVB, which I was the person who downgraded them and resulted in their run, so you can think whatever you think about that. But that institution, and this is in the public domain, so I'm not saying anything that's not public, but they had a level of unrealized losses on their government securities that were long dated, hedged with interest rate swaps, and then they decided to basically take an interest rate bet on Federal Reserve policy. They sold off the interest rate swaps, moved it into held for maturity, and I'm getting a little nerdy here. You can tell I'm a banking professor, but they moved it into a different account where it became unhedgeable at any point going forward. And I see you're not, what I'm talking about, but this was like an insane move, but permitted under regulation. And so, hey, it was all okay.
Well, you should never be holding any of these bonds other than as mark to market.
I agree with you. But I'm just saying that you create a culture in the organization And so we have to think about how do we transition to something else when you've got people who for 15, 20 years have become acculturated. And I saw that in spades when I was at Moody's.
Well, I thought you were on to that, and I thought you were going to make a suggestion at the end of your last part of the talk.
Yeah.
Because what you were arguing for was the SMCR, Senior Manager and Certification Regime, which we've got in the UK, which at its extreme makes a criminal act to mismanage a bank.
No, I think that is actually the
think
way to
that
go.
is exactly the way to
I
go.
think you should.
Yeah.
I agree with you on that, and that needs to be not diluted but doubled down on. I think that there are some. My sense is from some of my UK banking friends that there's a step back from that. I think I would actually lean into that because I think that gets you to an incentive compatible regime where, okay, I'm not trying to arbitrage a fixed set of rule-based regulation. I'm accountable for the outcome of the bank. I think that's incentive compatible and what one would ideally want as a policymaker.
Sorry, Tim.
Yeah.
Tim, any other remark, or shall we move on to another topic?
Yeah.
Well, can I just say, I know old stuff that some of these banks should have gone to prison, shouldn't they? Look, what kind of society are we? These people were taking risks. They're taking risks against capital. I said this is what they do, what we do in the cities, what we do all the time. I'm a capital provider at Lloyd's of London, by the way, all my life, by the way, after unlimited liability, all my career. Still have it today. So, make a mistake. Because it may just be a mistake, an honest mistake. Sorry, go to prison. I don't like that kind of society, I'm afraid. Sorry, no.
All right.
I think we have to be a lot on that. I don't think you're going to get a conviction if it turns out to be a very honest mistake.
Yeah.
But I'm not sure in the case of Bank of Scotland, RBS, Royal Bank of Scotland.
They were overtrading.
Oh.
As I said, we leave it there.
Yeah.
Yeah.
I had to deal with him occasionally. He was mad.
Prison, should he? Well,
No.
I mean, it was a...
To be honest with you, I think there are other places he should have been more permanently, but they were asylums.
Okay, but how about the other fantastic topics that I put on the table? Central bank independence and accountability. There's been a lot said over the last few years. Whether in this country, the Bank of England is independent from the government, should it be independent, and should it be more accountable? This is something Milton Friedman addressed decades ago. He actually thought that it's not that worth paying too much attention to the formality of central bank independence, but it's much better to give the central bank a binding rule to tie their hands properly, so they cannot be that discretionary. So what do you think about this?
So a couple thoughts as a former central banker. I do think that we've gotten, unfortunately, in advanced economies, central banking into the quasi-fiscal realm. And so when we are doing growth in the balance sheet in particular, I think we are kind of moving into a place that both can result in fiscal loss. It can result in credit allocation implicitly. We've seen that with, to an ever greater degree in my home country, in the United States, where we began when Fannie and Freddie Mac were having their difficulties buying agency mortgage-backed securities. That actually helped prevent their insolvency, but also was a form of credit allocation and difficult to unwind. And then in the most recent COVID example, we created facilities that, yes, they were never utilized, but their mere presence stabilize the corporate debt market, and I might argue have actually helped drive corporate bond spreads lower on a fairly permanent basis. If the Fed is willing to take out the table for you in certain crises events, in terms of the corporate bond market, you may be willing to provide lower spreads. Why is this problematic is that if risk is not correctly priced across these various markets by market participants, and they expect central bank intervention, that can become costly. And every time central banks do QE, they are basically buying government bonds when they are the most expensive, right? And then when they let those securities, certainly in the case of Bank of England, which is, in my view, as a central banker, a bit unprecedented, to be actually doing outright sales in the secondary market, The problem with that is that you're incurring loss. Of course, you're incurring loss if you just even, as we do in the United States, hold it on the balance sheet. You raise the federal funds rate and you're incurring a negative spread. And that reduces remittances to the government and widens the fiscal deficit. So these have very direct fiscal costs. But I think these have become overused tools. Why are they overused? Because the government and society have been conditioned almost to expect it. So I think this is a very detrimental development since 2008. And I do think that governments need to, I was discussing this with another, not a UK, not Bank of England and not my Fed colleagues, but another G7 central bank. I said, maybe you need to have the government, have an agreement with the government that you will only do unconventional monetary policy if they ask you, because there is a fiscal cost. So I think that these policies they're costly and need to be reconsidered.
Why were these decisions taken back in 2008? And it comes back crucially to regulation. I just explained in my talk that banks were required to hold much more capital relative to risk assets. So the banks then reduced their risk assets. So they go to their customers and say, look, sorry, you need to repay that loan. The company or the individual then sells an asset, typically money goes into deposit. Deposit's then used to repay the loan. So the deposit disappears from the economy, as does the loan. Money is being destroyed because deposits are money. So what, I'm afraid, these clever people operating at the behest, by the way, of G20 governments, what they were doing through 2008 and 2009 was recreating the background to the Great Depression in the USA. So how was this offset? I'd spent most of the previous 20, 30 years of my life trying to stop government monetization and that rapid growth of money, for that, as people in this room know, trying to advocating lower budget deficits and so on. I had to do a complete somersault. No, we now must have large-scale monetization of the government deficit to increase the quantity of money, i.e. we must have QE. QE was a necessary response to a stupid decision by regulators. That's what I mean, Jill, and that's probably may come as a shock to you that someone could say that, but that's what you cannot possibly tell a central bank, if it's a requirement of macroeconomic stability that money goes below to get inflation down and stable to achieve economic stability, the central bank must have freedom to carry out open market operations of the necessary type, including QE and QT.
But before, sorry, do you mind? Too. But of course, the situation back in 2020 was very different.
And yes, Juan and I agree. But 2020 is actually different because the banks are then not shedding their risk assets. So instead, the QE led to this explosion of money growth, and Juan and I immediately said it's going to cause inflation flare up, and our profession took 18 months to catch up with this.
So yes, central banks should have the freedom to make decisions as they see fit, but not that much. They cannot be that discretionary, so that the UK, for example, we increase the amount of money 3 times more than normal in a given year, 5 times more in the US, always gold medal, and in the Eurozone it was also twice or 3 times more. So that's what I mean by a Biden policy rule. Is inflation targeting is not enough if executed as it has been over the last few decades.
I mean,
sorry.
I'll be very quick because I want to. Is that the idea that central bank independence then means this topic is not something that the rest of public policy need to concern itself with. The central bank independent, they're all powerful, immaculate. The rest of it is nonsense. The central bankers may be people who don't understand basic monetary economics, don't understand that excessive money growth causes inflation, and then they'll do stupid things as they did in 20 and 2021. Okay, so indeed, there's more to say.
Sorry.
Maybe I'll just try to pick up on a couple of points. I think that in the United States case, at least, the initial use of quantitative easing was necessary. Why? Because we provided hundreds of billions of dollars of discount window loans. And in the environment of a recession, if the US had not engaged in quantitative easing at that time to basically stabilize the money supply, then we would have had a severe Great Depression. 100% see that point. However, the continued use of QE we're like on QE4, okay? And what we did in terms of COVID was we moved from, again, in the immediate moment of the COVID pandemic, I was still at the Fed. This was something that absolutely needed to happen because there wasn't enough economic activity, and literally the world was having an economic heart attack around there not being enough dollars in the system. However, we got to a certain point as the global economy began opening up, and we continued to provide QE accommodation to address treasury market function. And you can go back to the committee's minutes and look at that. We continued with that policy for too long. So, and we got out of it inflation. I agree with you on that point. When you ease fiscal and monetary at the same time, you will always get inflation. So I think we agree on a lot, but what I would say is that there is an incredible amount of discretion, particularly in the case of the US to some degree and other advanced economy central banks as well, about when do we do it, how do we do it, and even to the point of credit allocation. So that's what I'm raising. I take your point. We don't have the government come in and micromanage the central bank. I think we agree on that. Yeah. But I also think that we've gotten to a place where there are very large fiscal costs involved with some of these operations that are not being necessarily balanced well over time.
So if you're interested in monetary policy rules, John Taylor, 2011, for the Cato Journal, legislating a policy rule for the US. Tim Congdon, 2024, for Politeia, legislating a similar, well, it's a different policy rule, but for the Bank of England, based on monetary aggregates. Those are really good starts. And indeed, this one to understand the latest inflationary episode. So thank you very much. Thank you for my colleagues for their contribution to the debate, and thank you everyone for your questions.